Beautiful. Okay, just going to give it a couple more minutes here and wait for 6:30 just to be prompt and respect everyone's time. Should be seeing on the screen here the Savvy Tax Planning, how tax planning changes through your 4 stages of retirement. Hope everyone had a nice long weekend. Weather wasn't the best, but at least Monday was. And then we continue the trend of weekday wonderful weather and weekend cool and rain. But hopefully that shifts here coming into the summer. Again, just want to give it a minute just to let anyone else just hopping in here last minute and get started promptly at 6:30 for everyone. As you did join, you did hear that this was recorded. So something that we did start doing this year was actually recording these educational events and webinars that we host, really just by popular demand. People who weren't able to make it last minute or just would love to have joined for the content, but just weren't able to fit into the calendar or schedule. So we have started to actually record these. And it's something that besides yourselves, if you're going back to it or someone that missed it that we share it with, it's also something that you're now able to share and pass along to others. If there's others that you are thinking that this is good content for. All right, 6:30 on the dot here. So let's go. Savvy tax planning, how tax planning changes through the 4 stages of retirement. As always, like to kick things off just with a intro to our team and who we are and really why we run these events is believing strongly in education and helping our clients to make very informed decisions and setting the stage for the work that we're able to do for them. And really just on the screen here is our team, which it does take a team to do all the things that we do and all the things that our clients and just the world continues to expect and need from us to successfully navigate the land of retirement. So myself, Michael Perkins, retirement advisor and founder, a certified financial professional. RICP is a retirement income certified professional. Daniel Neville, GEO, certified retirement counselor, certified Social Security claiming strategist. So you and I are really the lead advisors meeting actually with clients and doing the planning end of things. And as you can see by the designations, we put a lot of time and energy and focus into being informed in this specific retirement space. And then Melissa Joyce, licensed marketing and communications coordinator. Well, we're to say that she does a lot of stuff for us, but she also is the lead on setting up these events, coordinating them, on top of coordinating with the partners and things like that that we do for all our other marketing and communications and anything that is coming in or going out for communications. She's really the lead on those and listening to see what else that it is that we can do to better communicate with our clients. Cassie Foley, sales assistant there, but she really leads more the operation side of things and stuff more on the back end. Also working with clients though to help if there's need to be addressed. All of us actually, what's crazy is we have about 50 years almost now of combined experience across the four of us. So what we do, confidently guiding you to and through retirement, the 4 key elements of retirement planning. Today, again, being focused on tax planning. We can see other key elements here for retirement planning: Social Security, Medicare, the tax planning, long-term care. 4 areas that you need to understand. And honestly, we believe your team or advisors need to be experts in order to help you navigate this next stage. And I personally believe tax planning is one of the most significant of all of them, an area where there could be the most opportunity, and at the same time, the greatest cost if you are making any missteps. So these educational events, again, we run them on a regular basis. We've actually started to implement even more of them. So whether they're on long-term care planning, Social Security planning, we have a couple more coming up actually in the next 1 to 2 months. Besides this tax planning, we have Social Security optimization, which will be a different look at Social Security than just understanding Social Security, but more in line to helping you make the best personal choice with optimizing Social Security for you. We have another one co-hosted with estate attorneys, Ken Simmons and Marco Schiavo, going through some estate planning with them in June. So you probably have, or I know you've already got invites for those, and we'll be continue to send follow-up for those as well. So kicking into tonight before we get into the actual formal, I guess, presentation here, but kicks off with a brain teaser. And this brain teaser is going to set the stage for what we're really addressing tonight. So I know there's some information, some numbers on the screen here, but just follow me through it. So the brain teaser. Bill, this hypothetical individual, he's retired. He has taxable income of just over $48,000. They say he's in the 22% bracket for taxable income, which you can see the table on the right there shows, hey, okay, at 22%, yep, $48,538. Yep, that would put him in that 22% band that you see there that goes from 48 to 103. He also has in there, it includes $40,000 in IRA income and $37,500 in Social Security benefits. So a key thing here to recognize, taxable income is not total income. Taxable income is 48,538, but we just said, okay, he has 40,000 coming from an IRA, 37,500 from Social Security. That's over $77,000. But what we're looking at here and on the taxable income, if he taps his IRA for an extra $1,000 for something like a concert trip, wants to take a road trip, wants to go see a band he hasn't seen, or whatever it is, just going to tap an extra $1,000 from his IRA to do this. It's like, okay, so he's going to take that $1,000 out. How much taxes is he going to owe on that $1,000? It's like, okay, well, we just said he was in the 22% bracket, right? So if we take out $1,000, okay, well, 22 cents on the dollar at the 22% bracket. So $1,000, he should owe $220, correct? Wrong. So he actually ends up owing $407 in tax, a 40+% tax rate on that income. So you can see there must be something else that we missed in that example to why that tax is so much higher. And that's something we're going to come back to this brain teaser a little bit later in the presentation to talk about what happened here to him and why that tax was higher. So again, the tax planning does change through the stages of retirement, and hopefully tax planning has been present prior to retirement, but it just really gets even more focused in retirement. You need professional guidance, whether it's accountants or tax preparers, CPAs doing your tax returns, working with professionals like ourselves that do pro forma tax planning for our clients, actually looking ahead. That's what tax planning is about, is looking ahead to the decisions that you're making. It's not the filing of your taxes after a year has already been completed. And at that point, it's all essentially said and done, and you're just getting the results of that year. We're looking ahead. So things that we look at, we plan for traditional IRAs, these tax deferred investments. You got to pay taxes on them when you take distributions. Or even if you choose to make conversions, we just have to know they're subject to federal and state taxes. Roth IRAs, they're not deductible, but the money does grow tax-free. Earnings can be withdrawn tax-free as long as you follow the rules. There's always rules. And typically, if you break the rules, there are penalties. State taxes, we're going to focus primarily on federal taxes here, just to be unbiased to the clients that we have in various states. But it is something that there are also state tax implications, and they do vary state to state. A new complex world. And there's a lot that comes with that when you think about retirement planning, but specifically in taxes, there is a big change that shifts when you work from those working years to the non-working years, or what we call in kind of your investment life and savings life, from the accumulation years, the accumulation phase where you're saving and building and amounting, hopefully the savings to live on later in your life or support or help you with that lifestyle, to that distribution phase when it's time to, hey, I saved it, I put it away, it's time to use it. It's time to spend it. And there's a big change that happens at that point. Besides that, we're also, a lot of us, conditioned to think, oh, well, taxes should be lower when I reach retirement, right? My tax situation should be lower. I don't have my job anymore, that income coming in. But we also got to remember that you also most likely no more have child tax credits if you had them. Maybe you paid down or off mortgages on homes that used to have large interest deductions. Your medical insurance, you might have had tax-free employer-paid medical insurance. You might have been making contributions to retirement accounts, pension plans, things that were all pre-tax or deductible contributions. And now all of a sudden you also have things like Social Security coming in, RMDs, required minimum distributions, rules that make you start taking money and paying taxes. You're paying for stuff like Medicare or supplemental plans, and you're paying for healthcare, long-term care, personally funded insuring, whatever it is, but it's just another thing that's factored into a long-term retirement plan. So it is. It's just a new and complex world, which is typically just because it's new. Something you haven't been there, haven't done that, so it can be complex. What's good is to know that there's a team like us out there that has been there and has done that. So what's the first thing I need to understand about retirement and taxes? Well, the first key is you got to understand what you have saved for retirement in a true after-tax spendable dollars before you're retiring or as soon as possible. And what I mean by that is just understanding that what is the actual dollars that you are going to be able to spend in retirement, not what the gross money is, which is kind of like when you're getting paid and your salary or income is a certain number, but then, taxes, things come in, and what do you actually get in the bank at the end? So in this example, we're talking about a married filing jointly company. Excuse me, couple, not company. They have $500,000 in a 401k or IRA. But what is that money really? It's not really $500,000 when they go to spend it if it was all pre-tax. Depending how they access that, what other income sources they have, if they're in a 35% tax rate or hit that level, that 500,000 might only be 325, or in a higher bracket, it might only be 315,000. We also have to remember that there's a time that even if you didn't need or want this money to spend, there's an age point where you're required to have these required minimum distributions. They have been kicking the can down the road as we are living longer and longer and people are working later into life. But right now it's 73 for anyone born before 1960. And if you were born in 1960 or later, the required distribution age is 75. So things that we help and support with as well as estimating what those future requirements are. Not my favorite chart because I feel it's a little hard to see, but the key here is the top line is showing you if you were to work with that same essentially an account over time, making a 6%, say, hypothetical rate of return, how much are you able to draw out of that account per year if you're taking out, 6% essentially per year after tax over a retirement period. So they're looking at age 70 as the start point and going out to about age 95. So they're just showing on this chart the effective taxes, where you can see the top line obviously much higher, above 900,000 at the end of the period that they'd be able to withdraw and take out of this, $500,000 account earning 6%, making their withdrawals, versus if they're paying a higher tax rate like 33%. Oh, okay. And actually, we're only able to get about 600 plus thousand out of that. So it's just, again, another thing just showing the cumulative impact on those after-tax distributions over years versus at one time. So, okay, so we're talking about IRAs, 401ks, how that works, how that's taxed when we're taking it out. But what about Social Security? I get that to rely on, supplement my income, pay my Medicare, health costs. But key number two, Social Security and Medicare have their own tax traps. And you have to be aware of them and you have to be prepared for them too. So Social Security and taxes, we're getting back to Bill here. So he was one that was subject to this tax trap. We call it a tax torpedo. Before his concert trip, we're looking up here on the left-hand side. Again, reflecting back on that first slide today, IRA income, $40,000. Social Security benefits, $37,500. Adjusted gross income, so after some deductions and things, or excuse me, at the total income is added up, or what would be taxable income, comes to 48,500, which is after the deductions from the adjusted gross income, and then the income tax number of 5592. So what he actually pays out of pocket in tax, those tax rates. And then coming to the other side, again, you don't have to know the exact numbers of the AGI to taxable income, but just the change here. Again, what was the impact of that $1,000? Why did he get hit with that extra tax? Well, so that $1,000 all of a sudden put him at adjusted gross income level that was higher than $1,000 more. If you compare the AGI on the left to the right, it's like he took out an extra thousand, but his adjusted gross income went up by almost $2,000. His taxable income went up by almost $2,000. So why did that happen? We only took out an extra $1,000. Well, what happens is tax torpedo, there is an increase there because Social Security has a special tax treatment, and only so much of your Social Security is taxed at certain levels. But if you cross certain lines, all of a sudden more Social Security dollars are becoming taxable behind the scenes. And because of that, actually for each dollar, it was a larger than $1 increase in income. It was $1.85 to his AGI and taxable income. So again, these things are just kind of, they're hidden. They're not in plain sight. They're hard to know and to see coming. And an extra $1,000 seems no big deal to take out of your IRA. But if you took it out and knew you're going to pay over $400 in taxes on it, so I take out 1,000, I only get 600. It's like, oh, well, that doesn't seem like as good of a deal as I thought it was when I was going to pay $220. So just being aware, right? And having people looking out for you as well to know if we're going to cross those lines. Again, just reflecting that number of what it ended up being, that $407 out of that 1,000 and being essentially like a 40% tax on those dollars instead of that 22. Then we come to Medicare. So Medicare and taxes, they refer to it as an IRMA cliff. Not a bad way to look at it. Also, another kind of tax torpedo, but IRMA cliff as well. So looking at a hypothetical of a Georgia Martha, what happens is Medicare has certain premium rates, but there's also income rules to them. So in Georgia Martha's situation, they are Medicare, they have Part B and Part D. They have good income coming in, modified adjusted gross income. That's what that MAGI stands for, 334,000. A key part of that thing where we're throwing at you already, taxable income, adjusted gross income, modified adjusted gross income. The things that affect the Social Security rules, the regular tax rules, the Medicare rules, all follow these different tax numbers that you may or may not even be aware of to have, well, what the heck is my MAGI and how do I know what that number is to know if I'm even going to cross these lines? So in their situation, they sell a stock for $1,000 gain and owe taxes on that. They're saying, oh, $188. Where that comes from is saying it was a long-term capital gain. So 15% is a flat long-term capital gain for federal, so 150. They have high income, so there's a level where you reach where it's this thing called net investment income tax. There's extra surtax that happens. So that's why you get hit with that extra $38. And that's a known thing for them, at this income level. So $188 in tax, right? Well, what they did was they went off the IRMA cliff. So all of a sudden they crossed that line of income where you can see MAGI, married filing joint, the circled example. If you cross $334,000 and go into $334,001, all of a sudden you have this thing called IRMA, income related monthly adjustments that happen to your Medicare. And their Medicare premiums in Part B alone actually went up by $110 each individually for the entire year. So an extra $220 per month that now they triggered by taking out that extra $1,000, which again did not seem like a big deal at the time. But it's not just Medicare Part B, it's Part D and those drug plans or supplemental plans, whatever they are, they all follow these rules and guidance. So their drug plan also went up by about $40 per month. So you can see all of a sudden where these costs can really, really start to add up, those extra premiums. Now it's actually over $3,000 of extra cost and charges on their Medicare premiums because they took out $1,000, excuse me, they might not even have taken this money out. They sold a stock or an investment that had $1,000 gain. They may not even have spent the money and took it out, but they made a decision to sell and it was a tax event. And that's what triggered this. So now not only did they have the Medicare charges, they had the initial, expected 15% long-term net investment income tax. So that all on top, it's like, oh my God, we took out $1,000 and it's going to cost us almost $3,400 because of that. And again, I said took out, but just because they sold or moved something around, it triggered that. So you can see as we're going through these different stages of things to consider. And within Medicare, besides the Medicare IRMA cliff, there's also the worry about Medicare enrollment, coverage gaps, late penalties. Coverage gaps meaning, if you have a time or a lapse of coverage for some period of time that you might be without insurance, if something were to pop up. And then penalties, that there are late penalties. So we're going to talk an example here of Jim and Ann. And they are 68 years old. Jim retired at 65, and 1 year later at 66. They have coverage that they got through Ann's employer because they offer retiree health insurance, which is fantastic that they have that benefit and that ability to go on retiree health insurance. But when do they need to actually enroll in Medicare Part B? They got to do it as soon as they retire. So you can't get Medicare coverage instantly. You have to go through and apply ahead of time. So make sure things happen on time. But if you have a missed enrollment penalty, 10% of the base premium is a penalty for life. So you are paying a penalty premium for life. They're showing here $185, and that is because that's the Medicare Part B base amount. So it would be higher if it was not the base amount, but that's where that 185 is, and 10%, essentially it's an extra $18, $19 to have to pay each month, but not for just one of them, for each of them. So again, a cost that each year adds up and could translate into a lifetime of an extra $10,000. But at the same time, you also got to watch out for those coverage gaps. And that was something where they had insurance coverage through her employer, but a lot of those employer plans work around Medicare. So you have to enroll in Medicare and also go on the retiree healthcare. Sometimes employers, they're getting better at helping and coaching along people, but you want to make sure that your employer really understands and does this often if they have retiree healthcare plans, that they are aware of Medicare as well. So you want to make sure that you're educated and asking good questions and aware if there's anything that's being missed, because they won't be the ones to be paying the penalties, you will be. So, wow, are there other tax traps that we will face in retirement? And the tax traps are always there even prior to retirement, but as you can see, there really are some focused ones here in retirement that come out in this new complex world. You have to plan how and when you use taxable money. So that example earlier of the couple selling a stock, maybe they didn't even spend it, but what that did to their Medicare. Tax deferred, again, those IRA 401k pre-tax accounts, when we take it out, we have to pay tax. What does that do? What brackets does it put us in? Does it subject us to those other like higher Social Security tax or anything like that? Tax-free assets. Do you have tax-free assets? How do you juggle all these things together so you can manage your tax brackets and these tax traps to the best of your ability? So things we consider and do and we look at, consider Roth IRA conversions, right? For some, not for everyone. Sometimes it's even just proactively withdrawing monies, whether you're putting them into Roth IRAs or funding a hybrid long-term care life insurance policy or something like that, where it's a proactive decision to move some monies from these pre-tax buckets to an after-tax bucket. And taxable income in this situation, when you do these conversions or draw monies out, it's added to your income. So if we convert in this example, Jill converts 100,000 from an IRA to a Roth IRA, well, that 100,000 is added to her income. It's taxed at that rate. It doesn't mean, again, that that's a bad thing, but you want to be aware of what happens. So I like this bucket illustration because there are times where you're in a certain tax bracket that you want to fill up that bucket. We have some very beneficial tax rates right now. 10%, 12%, 22, 24, 32. Some of these used to be 10, 15, 25, 28. And we have to be thinking of taxes not just today, but into the future of 1, 3, 5, 10, 15, 20, 25, 30 years into the future when we're planning for retirement. So in this example, we're talking about filling a tax bracket. And you can see before conversion, using that bucket, 10 is full, 12 is full, 22, just over half kind of full. And then the conversion strategy, let's fill up that 22. I feel good about paying 22% federal tax. I'm not projected to have a lower tax rate in the future. It is a beneficial move for me to pay that 22% tax now and start making monies that are going to be tax-free for me in the future if they continue and should continue to grow, versus the money's hopefully growing still, but in those pre-tax accounts, it's also growing a bigger tax bill for the future. So other possible things, well, what other assets and things have you built over the years? So if you need money, whether it's for regular income, life emergencies or life opportunities, helping family, moving or buying that dream home or vacation home. This time where you need to access monies, but you have to be aware of, okay, what's the impact of different monies? Some things like life insurance policies sometimes allow access to tax-free money. Sometimes you're in a position where you might actually be able to sell highly appreciated stock at low or no capital gains. Certain years where an income level is low enough, sometimes you pay no capital gains tax, or you know that you're just going to pay that 15%. The bucket illustration we had previously, the IRAs, the 401ks, are we in a good tax bracket this year? Is it a year where, hey, this looks pretty good, and it makes sense to proactively actually take some money out and pay taxes? So a couple of other things that are pre-retirement. So, never too soon to be planning. But if you qualify, things that people can also strategically use and we help with, as well as healthcare savings accounts. So if you're on a high deductible healthcare plan, a lot of times, and really you should have an HSA account as well, whether it's set up by your employer or set up by yourself. And there's funding and things you can be doing to those for tax benefits while you're working, and also future benefits to them when you are not working. If you're self-employed, running a business, you might have access to a qualified business income deduction. So there's certain things you could do in the tax world to help you qualify for increased deductions, and allowing you to fund, funding things like retirement that might actually allow you to then get an increased tax deduction on the other side. So you put money away for future you, and at the same time, it saves current you dollars that you would not have otherwise been able to save. So there can be dual benefits like that. The things of why tax planning is so important pre and especially post retirement, where we have the most control over it. So pivoting a little bit, but talking about other things that many and a lot of us do on a regular basis is things like charitable giving, but bring charitable giving into tax planning. So Albert and Shirley, 24% tax bracket, they give $5,000 to charity, something that they regularly do. They have existing itemized deductions of $15,000. The standard deduction, because the standard deduction for all of us has been increasing recently. It's over $33,000 in 2025 for a married couple at their ages. So that $5,000 donation doesn't get any federal tax benefit, right? The thing is, when you're doing your tax, you either take the itemized or the standard, whichever one's higher. So even with that charity gift of $5,000, their itemized only come up to 20, so they're still going to get the standard. Not saying that they can't give or donate the monies themselves, but there's not going to be any tax benefit to doing so. They're going to just donate the $5,000. Something to consider, what about a qualified charitable distribution? So something that you could do when you're after the age 70 and a half, and you can do up to $100,000 from an IRA per person, is send that money directly to the charity from the IRA. It actually counts as an RMD if that's required, and it's not reported as income to you because it was given to the charity. So no deduction on the income tax, but it's not reported as income. So talking about these options, we're donating money, but there's a couple ways that we could do this. And what's the best way? So what's the cost of doing a non-QCD, qualified charitable distribution? So just a normal, the first example, we're going to give the charity $5,000. The charity, if you're doing it from an IRA account, okay, well, that might still satisfy your RMD, your required distribution, but you take that money out, it is reported as income, taxable income. So now your tax bill on that distribution, if you're in the 24% tax bracket, could be $1,200. So you gave the money to charity. You also then pay the tax bill. So that charitable contribution cost you $6,200 because of the tax on it, and then the money that you had given. So IRA to checking account to the charity, as the example goes on the right. Versus here, what if we go IRA straight to charity? The charity gets $5,000. You still satisfy the RMD. The money now is excluded from taxable income. No tax bill on it. Now all of a sudden you gave the $5,000 to charity, but you also saved yourself $1,200 in taxes that you'd have to pay for your RMD. So you actually were able to give $5,000 at really a net cost to you of less than $4,000, $3,800. So again, good to be giving, but at the same time, if you can do that and you can spread your monies and stretch them more for yourself or for more future giving, I would be going with option 2 here if I had a choice. So talking about some of the later stages of retirement as we're getting to with the charitable giving and thinking about, okay, maybe I want to pass on some assets to my family and thinking about how does that impact things? How does taxes and retirement planning figure into setting up my family for the future? Another thing that you got to have a lens on when we were talking earlier about for yourself, okay, where are we drawing money from? What are we taking from? Tax-free accounts, IRAs, taxable investments. Okay, well, you also have kind of the end in mind as well of, okay, well, if we have monies left or we want things to go to our family, well, what's going to them? How's it going to them? So you have to organize your assets also to your family's benefit. And the estate planning definitely still matters. So taxes and long-term care, an understanding of this, that we're going to bring to the surface, hopefully, something that's enlightening to many people. But premiums may be deductible on federal and state levels for paying for long-term care, policies, premiums, payments from the policies for reimbursement of long-term care expenses. So meaning you paid into thing, but now you're taking money out to pay for expenses. Those are tax-free. So you're getting that money out tax-free, which is a nice benefit. But choosing how you pay for those long-term care costs, because that's the end of the day what we're talking about. It's just there's a cost for me to have some help and some care and ongoing needs. And how I pay for those has an impact. It has an impact not only on yourself right now and the monies you're working with, but also to what might be left or the impact on your heirs. So this example of Florence, who's a widow, we have a choice here. If she has IRA money, and she also has a life insurance LTC policy. So these hybrid policies that are very much popular nowadays, where there's a life insurance benefit if you pass away that pays to your family. There's also a long-term care benefit that's accessible to you if you need help and care to use funds for that. So let's talk about this example here where she qualifies to use the LTC benefits, meaning she can access her policy, she can start getting monies out of there. And she's able, or she receives currently $60,000 a year in-home care benefits. But again, that's the thing about these things, that you don't have to be, residing in a facility or nursing home or anything like that. Most all of these policies, the new ones now, offer you in-home benefits. You want to check and be aware, but most all of them now have those options. She has $20,000 a year coming in from Social Security. She's got $400,000 in an IRA account. That life insurance with LTC rider, it has a death benefit, $500,000. Meaning that's if she passed away, that's what goes tax-free to her children upon death. Or it has the option, it's kind of an and/or, but it also has the built-in $10,000 a month that she's able to tap for something like LTC cost. So let's think about this. Florence has the need. She has the money to spend. She has the policy that's accessible. So let's see. In scenario one, she uses the LTC policy. So, okay, I'm qualified to use this. I set up this policy. I can access this money tax-free. I'm going to pay for care. She ends up using it for 5 years. But understanding that Florence pays little to no income tax during those last 5 years of life when she's on some of these long-term care benefits, or essentially has really high care cost. These high deductibles, they can be or for unreimbursed medical expenses, they would be itemized deductions, so she pays little to no income tax. Her LTC insurance will pay the $300,000 for in-home care, the $60,000 a year, because remember she could get up to $10,000 a month. She doesn't even need that much from it. And then her kids at the end of the day would inherit what's left, what she didn't spend. So that's the thing with these hybrid policies. She used $300,000 for her care. Well, there's still $200,000 that goes tax-free to the kids from that policy. And then they also get a $400,000 IRA. But the IRA, it's taxable. And now the rules with inherited IRAs have gotten stricter, and there's rules with distributions. And depending when your children were to inherit those monies and where they're at in their life and what their income situation is, it might be difficult or very costly for them to access and use those monies. And a lot of it might just get eaten by taxes. When we flip this and we look at, okay, well, what about the other way? What about scenario two, which is a little more outside the box? Because again, we have an insurance policy. We set it up for this need and purpose. So, but what if we choose to go the other route? I have an IRA. I can pay out of my IRA. Again, Florence has little to no income tax during those years because she has very high medical cost. So you use the IRA money to pay the $300,000 for in-home care, $60,000 yearly. Again, we're just saying, okay, so we took that out of the $400,000 talking about any growth or anything else. Now the kids get $500,000 of tax-free money that is cash. They can invest it for their future. They can buy a home. They can pay off debts. They can put their kids to school. Number of things they can do and access that money with all these tax worries and concerns, as well as an IRA with $100,000 that will, again, fortunate to receive anything, but will have a cost to accessing it, how and when they do so. There'll always be taxes. So again, a little outside the box to think that we have a person who has the IRA savings, they have the LTC insurance and coverage there, but you can see the benefits of using scenario 2 for this picture. She was able to still get the care that she needed. She still did not cost a large amount of taxes because of those tax deductions, which you monitor and check, and then was able to pass on tax-free monies to her children instead of a taxable IRA. And if she needed more extended care, again, she had her IRA to continue and she still had her policy that would have been available as well. So it's just that comparison of use of using the taxable money versus the tax-free money. And it's just not what you might have thought it was on the surface of what might be the most beneficial. So it is a lot. It's a lot to manage all of this. There's a lot of things that are moving parts. And at the same time, as you bring it all together, the thing is that these moving parts, they continue to move. So pre-retirement, we want to know what your after-tax savings is. That's the goal. So as soon as possible, you want to really understand, some of those commercials, what's my number? Or we get asked, how much do I need to save? It's loaded questions for many reasons. But one thing is, well, what is it really? What do you really actually have when we peel back stuff like taxes in those accounts? Fund Roth or pay tax or have tax-free access to money. You just want more options, honestly, as you transition to retirement of places and areas you can access. Early retirement, you're getting introduced to this whole new complex world, understanding Social Security and Medicare taxation and how you can navigate those. If there's beneficial years, low income years, maybe before RMDs and things kick in where you're able to fill some of those tax brackets, play the tax game proactively, thinking and looking ahead. Again, it's not always about kicking the tax can down the road. It's about trying to make sure you pay the lowest tax on those dollars and stretch and get the most out of them for yourself, for family, for organizations you care about, just to make your hard-earned dollars go as far as they can. And sometimes that actually is by paying tax sooner than later. Those middle retirement years, do you know what your retirement required minimum distributions are going to be? What they're going to do to your tax situation? Have you done those type of projections? Is that worked into your plans? We talked about how those could be potentially used as gifts if you're someone that does give to charity on a regular basis. Well, okay, well, I can continue doing that, but if I do it this way versus that way, it might be a big difference, right? And then the late retirement stage, talking about how we can really stretch these assets again from a tax efficiency estate planning standpoint for heirs. And again, whether it's family or charities that you're giving to, but just again, taking hard-earned dollars and that you saved and sacrificed for and stretching them even further. And sometimes what seems like the simple solution might not actually be the best solution. So tax exposure, it changes throughout retirement through the different phases, as well as we know that tax laws also evolve and change and brackets and things. Just our tax policies are complicated and then they continue to evolve. So you have to be ongoingly reviewing these things. You have to try to anticipate your options and what they'll be to cover different things, expected and unexpected. They might not be always bad, but sometimes there's opportunities. Maybe it's funding a wedding or helping a child or a grandchild out or something like that that you want to be able to do, but what's the impact of that? Are you planning for those things in the future? You just got to try to manage your actions so you pay the lowest tax rate possible so you can get the most out of those dollars for yourself and things you care about. So preparing for those retirement taxes, the distribution phase, it just gets more and more complex at that point. There's just a lot more moving parts. And honestly, you just have the ability to impact things far more greatly by making little moves and choices and decisions than in those working years where it was, honestly, it might not have seemed like it, or it might not now if you're still there, but it's pretty simple. The money's coming in, the taxes are paid. A lot of it is what it is. There's some tax planning and things you could be doing, especially when you're thinking of that distribution phase and preparing for it, but it absolutely gets more complicated and it's more costly if you make mistakes. So managing taxes is ongoing throughout retirement. The mistakes, as we pointed out, can be costly. You think you're going to pay 22%, and all of a sudden you're paying 40%. Education strategies, advice needed. It really is just talking why we run these events, right? Educating yourselves, enjoying this is a big step to getting good high level information. Hopefully we answered a lot of questions or brought some clarity or brought some stuff to the surface. Also allows you to then have one-off conversations with us, and also to please share this with others as well that you think this type of tax planning would be a benefit to. I don't know who it could not be a benefit to. Like I said, it's one of our kind of flagship services that we believe really enhances the value that we bring to our clients. So happy to review taxes and retirement. Honestly, anything we do and work with our clients, taxes are a focus, whether we are blatantly telling you we're doing a tax review, but just very much know it's always in the background of the decisions and recommendations that we're making. And sometimes those decisions and recommendations are the now today ones. And also knowing that we have the perspective of helping clients to and through retirement for years now, going back to 2007. So at that point, we have seen the mishaps. We've had the experience of doing things you only get to do once. So it's just why we have that ability to give you some transparency and clarity around things that might seem very unclear at this point. So I think that wraps us up. Questions? What we do is really ask if you have any specific questions, just to fire things off to us in an email or follow up with a call. Anything specific that you'd like to share, even if it again is something like share this presentation or someone that you'd like us to pass it along to, please don't hesitate to ask. Hopefully you enjoyed the content this evening, and we hope to see you again at another one very soon. Thank you very much. Take care.